Hey everyone, welcome to the Carson Investment Research Take 5 with Ryan and Sonu. This is a big one, Sonu. It is our Outlook 2025 Animal Spirits. So I guess there's a few things we'll start. Maybe I'll start with this. Want to just give it away real fast and then we'll dive in? What do you think? So no recession, pretty solid economy. We'll get into that. Stocks gain between 12 and 15%. Not quite as good as the last 2 years, but hey, we're not going to complain too much if we can get that. And then bonds between 4 and 7%, which would be potentially one of the best years for bonds we've seen in a while. But Sonu, let's, again, we want to try to keep it 5-6 minutes. What does animal spirits mean when you hear that? That's our theme, animal spirits.
I think what's been missing from this bull market, this 2-year bull market, or even if you rewind 5 years over the last 5 years, 2020 through 2024, the S&P 500 has gained 97%. It's almost doubled. Over the last 2 years, we've had 2 years back to back. The S&P 500 has gained 25% plus, right? Or exactly 25% in 2024. But we've been missing something. I think what we've been missing is that, the exuberance. I'm not saying exuberance is always a good thing. People have been skeptical about of the bull market. You see, even I just said bear market because that's in the zeitgeist, right? But I think now we could see a shift, right? The mood could shift, right? And the mood, not just for markets, but even the economy, right? To drive investments, consumer sentiment, business sentiment, all of that. That's what we mean by animal spirits.
Well said there. Again, keep it simple. We've had a big run and there's been some optimism, but you look at, like IPOs, there's no IPOs. There are these pockets of things that really consumer confidence has been very low historically for a while. We've talked about that, but let's talk about that economy. The economy 2 years ago grew almost 6%. Last year, 2024, and final numbers aren't in. Maybe between 2.5%, maybe closer to 3%. Yeah. That's really solid. We think we can have another better than average trend for the economy with no recession. I mean, so again, we want to keep this quick, but what are 2 reasons you don't think we're going to have a recession next year?
I think one is the labor market is still in a fairly solid place. Remember, 70% of the U.S. economy comes from consumption. Where does consumption come from? Incomes. Income growth is strong, right? Because employment growth is fairly steady. We think it'll slow, maybe 150, 170,000 jobs a month, but wage growth is strong. Wage growth is running around 3.5%, 4%. Again, that's important because we don't think that's inflationary, but strong enough. That's what we saw in 2019. So I think that drives consumption. We just got, we see that in retail sales numbers, all of that, right? And then the other side is consumer balance sheets. Household balance sheets are really strong. It's in the strongest shape we've ever seen. Why? Because stock prices have gone up and real estate prices have gone up. A lot of people also have cash in the bank, earning 5% or 4.5% now, something like that, right? So we're in a good place with respect to the backdrop of how U.S. households are faring.
I love it. I'm in Yuma, Arizona right now. The second warmest city on average. Death Valley, California on average is warmer, but there's no city in the entire United States that has more sun per day than Yuma. Right. So it's pretty nice.
Here in Chicago, I've been sitting with just gray skies for I don't know how many days.
We don't have that here. But I was in Phoenix yesterday talking with some clients, and they pointed out, yes, housing market, certain places. Now, I know that's just Phoenix, but a lot of places have made, a lot of people listen to this, hopefully made a lot of money with this bull market. Bonds and but real estate, different areas done really well. So the stock market, listen, we're looking at back-to-back 20% years, like something like you just said there. Two things I think we're optimistic about why this bull market will continue. You talked about a strong economy. That fills into earnings, right? We're looking at record profits this year. Maybe S&P 500 expected earnings up 14 to 15%. I think it's possible, right? With a strong consumer and a strong labor market and a strong economic backdrop. The second layer to this is profit margins. Profit margins hit new highs this cycle. For 2 years, so we've been told profit margins have to go down. Profit margins have to go down. When you've got profit margins making a new cycle high and profits making an all-time high with a strong economic backdrop with, I guess we really talked too much about the Fed. We'll talk about the Fed in the next part with a potentially a little more dovish Fed than they're telling us. These are some reasons to be optimistic on the equity markets. One more thing. If your average year gains about 9% for stocks, which it does, after a 20% gain, Sonu, it's happened 21 times, that next year is actually up 10.5%, more likely to be higher. That's not a huge jump, but I'm telling you, it's a better than average year after a big gain. And that's not just one reason to be bullish. We've laid a lot of other reasons, but I think don't be bearish because we're up 20% here 2 years in a row on equities. But let's go now to kind of the bond aspect. And I know we're going to talk about rates and the Fed mix it all in. Last year, right now, we were told the Fed would cut 7 times. We said, no. We think it's like 3 or 4 because the economy's stronger. I think we pulled a 180 now because now we're being told 1 cut. Some really smart people are saying hikes. I think we're taking the other side of the crowd in 2025. How do you see the Fed, hikes, and bonds? Wrap it all up here in about a minute, Sonu.
I think the Fed cuts maybe 2-3 times. I think they continue cutting. I mean, it's always hard to say. I mean, it's conditioned on the data, but the way we see the data right now, it depends on inflation, right? And we think inflation will continue to ease. It'll get closer to the Fed's target, whether it gets to exactly 2% or not. That's an open question, right? But it will get to that range. It'll go in that direction. That's good for the Fed to cut. The cuts may not come immediately. It may be after June. But, I think we will get cuts, and that should be another tailwind for the market. The other piece of this is that you talk about profit margins. Why are profit margins going up? Well, companies have operating leverage, right? They can increase profits while sales are going up. They're more productive, right? And we are seeing that translate into aggregate productivity growth as well. And when you have strong productivity growth, you can have strong wage growth with low inflation. I think that's what will allow the Fed to cut.
Some nice combos there. One final thing I want to point out. So hopefully we've laid out why we think stocks will have a better than average year. Not quite as good as the last 2 years, but still solid. Bonds might have one of their best years we've seen in years, which is great. Because a lot of fixed income people out there, it hadn't been very fun when rates go up. We may be a little surprised lower, and the economy overall is solid. Just know this. Most years see a peak to trough at least 10% correction in the S&P 500. We didn't have one last year, so no, we barely had a 10% correction years ago. So, hey, we're probably due for some volatility. We're due for those scary headlines. Every single year has scary headlines. So just plan, right? Plans are useless, but planning is everything. President Eisenhower liked that one. So plan for some volatility and scary headlines, but it is still a bull market. With all that, this is the latest Carson's Take 5 with Ryan and Sonu. We're really excited everyone got to listen to us. Hopefully you can go look into a little bit more our Outlook 2025 Animal Spirits. We'll see everybody next week. And Sonu will be a lot colder when I talk next time. I'm not going to be standing in a desert Arizona. We'll see everybody. Thank you. Take care.